Pratik Agarwal, CIO at ASK Investment Managers as well, joins in on the show. Pratik, hi, morning. What explains the kind of weakness that we've seen in the last few trading sessions?
Well, one, I think budget was short of expectations in the sense that it did nothing to inspire private sector spending on capex. Two, it levied surcharges which kind of hurts earnings by 1.5%, and that too in a scenario when overall earning outlook before the budget was 12 to 14%. So, versus 12 to 14%, now you're looking at 10 to 13% kind of an earnings range. So, I think it is a combination of these two factors, plus the fact that insurance and mutual funds seem to be losing a lot of money on a continuous basis. So, while we keep getting FII flows, they continue to be strong, but they are kind of matched by domestic sell-off.
Right. So, Pratik, at the current juncture, does it make sense to be more pessimistic than optimistic?
See, Nikunj, if you are looking at the index per se, our senses this year, from where we are, one should expect to see earnings kind of returns for the index. That would be somewhere around 11-12%. So, expect a percent or thereabout kind of a move every month. What happens is, if the market moves up 3 or 4%, people start to feel a bit more positive, but it is not sustainable in the kind of earnings momentum that we have. It's very, very meager earnings momentum. If you look at the part of the market which is high quality, there the earnings momentum is in excess of 20%. And valuations are average of what we have seen in several of the last few years. So there, frankly, there is a higher degree of hope of making higher returns. So this is contrary to the popular perception. We are not saying you go to the cheap part of the market. We are saying you stay in the quality part of the market. There the visibility on earnings is, let's say, 20% or better. And you should be able to compound your monies in that manner. The not so good quality part of the market, the cheap part of the market has various issues. They don't seem to be going away. And hence the returns in that part would continue to be extremely volatile.
Pratik, but are you happy to pay that premium to quality, because most of the quality stocks are trading at the peak valuations?
No. So take any stock, look at the PE that the business commanded, let's say 5 years back, and look at the PE they command today. My sense is the PEs would not have changed. Frankly, for one of our highest quality portfolios, the returns have been lower than the profit compounding over the past 5 years. While they have been way in excess of the market compounding, but versus profit compounding, they have been lower. So even the highest quality part of the market, where earnings are very visible, where ROCs are very high, there again the market cap compounding has trailed profit compounding over past 5 years, which basically means that the stuff has gotten slightly cheaper as a portfolio. So I think that is the best part of the market to be invested into. You look at the cheap part, there is nothing to suggest that the cheapness will go away. Cheapness will go away for asset heavy parts if interest rates go down significantly. When your credit growth is 17%, your deposit growth is 13%, even if RBI cuts interest rates, will it get transmitted down? Okay, yes, banks would benefit, but then which banks? Public sector banks are highly levered. They need to continuously raise money. They may seem to be cheap on paper, but they are not cheap because they will raise money at lower than one price to book.
Pratik, what's the market building in when it comes to the RBI policy? And is a fraction of the market also thinking that perhaps it's going to be a no-go status quo day?
No, we believe that there will be a 25 bips cut. There may also be a liquidity infusion. This is busy season, and like I said before, the credit growth and deposit growth, there is a large gap. So there may be liquidity infusion also.
Pratik, if I look at your declared portfolio, you have a large exposure to IT. Now, what makes you bullish on IT? The fact that Indian rupee will remain weak, or the fact that US economy has recovered?
Nikunj, we have a large exposure on IT, but if you look at the index, we are underweight IT, we are not overweight. But on the margin, yes, we are getting more positive. This is a year wherein every company is telling us that the growth will be better than last year. So if somebody has grown at 15% last year, kind of implies that this year they will do 16-17%. Somebody who has done 10-12% will do 13-14%. So, it is better going for everybody this year. The challenge is to understand whether this is a one-year phenomenon or it will continue for a few years. But as of now, we are slightly underweight IT in our portfolios. But yes, we are very closely looking at export-oriented businesses. We are heavy on pharmaceuticals. Pharmaceuticals would be 15-16% of our portfolio. IT would be close to 5% of our portfolio.
Pratik, as a house, what's your call on metals, and does it make sense to buy into metal stocks right now?
It is extremely challenging to understand what assets do they own. It seems like they own a coal block one day and then they don't own a coal block the next day. So in that kind of an environment, plus the fact that globally growth seems to be slowing down rather than accelerating, it is an extremely challenging environment for metals. In a volatile market, to be in that kind of a volatile space, chances of people losing money are significantly higher than making money, even if they get the entry point right. So we are staying completely away from metal and mining.
Pratik, are you using the current risk aversion in mid-cap stocks to your advantage, and are you looking at buying from something from the mid-cap rec?
Yes, we of our portfolio, 10-15% tends to be mid-capish at any point in time. It is that way, except that luckily for us, our mid-cap basket has not cracked in any significant manner. So, our ideas basically come from insecticide, pesticide areas or seed areas. So basically agri-related businesses, which if you see the market have held up much better.
Pratik, what about real estate? Is that too an avoid territory?
Not entirely. So I said this before, in India there are 4 clusters of real estate. One is UP based, the other is Delhi based, third is Maharashtra, Bombay based, fourth is Bangalore based. Our sense is that the other 3 parts are either highly levered or low on corporate governance. It is the Bangalore real estate companies which probably have some degree of hope, and where the valuation matrices are just about okay. So while we don't hold any real estate, but frankly we are looking at Bangalore real estate companies very closely. Some of the Bombay names may be high quality, good companies, but there the valuation comfort is not there.
Pratik, if I map what auto companies have reported when it comes to their monthly dispatches, there is a visible slowdown there. But if I look at the existing P multiple for a Bajaj Auto, Hero MotoCorp, Mahindra & Mahindra and Maruti, even though sales are down, P multiples are still holding on.
No, every stock has cracked. We are not very positive on this space, except for guys who can export a pretty decent part of their total output. We don't want to look at Indian demand at all. We believe Indian demand would continue to languish. Maybe in the later part of the year, when spending related to elections comes in, two-wheeler kind of businesses may see some amount of demand uptake, but cars, to our mind, would continue to see degrowth in demand for a long period of time. Trucks, frankly, LCVs are still okay, but the larger trucks where people make most of their monies would continue to be under stress till at least the mining, the stoppage of mining is removed. So overall, we are pretty negative on this space. Even in two-wheelers, you have a Honda coming up, a new big entrant taking away market share from everybody else. So while overall volumes may not degrow as much as, let's say, cars, but yet for each of the listed players, going may be tough.
So Pratik, final question. You are underweight on autos, you're neutral on IT, you don't like metals, and consumer names are expensive. So what do you own?
So a lot of our names are bottom-up names. In terms of sectors, we do own autos. We are not underweight actually. We own one name, and that's a 5% name with us. We are overweight pharmaceuticals. That in any of our portfolios would be 15 to 16%. We own a lot of the agri-related businesses, like I said, seed, insecticide, pesticide kind of businesses, which have been growing pretty well over the past few years and may continue to do so. Apart from it, we like businesses which aim at rural customers. So small ticket items, pots and pans, kind of stuff that gets sold there is stuff that we like. Consumer FMCG businesses, while we do not have too many of the index names, but we like this space and we are overweight on FMCG as well.